We're back in the open agenda and into item 10. We're welcoming Andrew today from LGFA, and Andrew, I'll open the floor for you and your presentation. Members, you'll find that as a late attachment on page 119, and Amy's got it up on the board as well. So, Andrew, the meeting is yours. But before you start, can I just highlight to members that Andrew's presenting the annual report to our meeting today, and if we can keep our questions at a fairly high level on a broad nature, that would be welcomed. We have a workshop for members PD set for after this meeting time, and that's when we can perhaps delve into some more Hamilton City Council specific questions or issues to raise with Andrew. So that said, Andrew, the floor is yours.
Thank you. So LGFA was created in 2011, and when it was being talked about, Hamilton was one of the 9 councils that were instrumental in sort of creating it. So sector debt in 2008 was about $4 billion, and it's now up to sort of $25 billion. So, I mean, LGFA has served a very important role in providing financing to the sector as it's embarked on a significant infrastructure sort of investment and also growth investment. That said, we're at sort of quite an interesting sort of crossroads at the moment with the sector, some very key political decisions to be made about what local government will sort of look like, and that's going to have quite a significant impact on the sector, and also potentially on LGFA and what role LGFA does to support the sector. I'll touch on the annual report, so I've got sort of a few slides there on it, which happy to sort of refer to. The last year we saw a record year of lending to the council, so nearly $4 billion, or very close to $4 billion of loans made to councils. And that's really LGFA's primary role, is to ensure certainty of financing to the sector and to keep borrowing costs as low as possible. So things like profitability are secondary to that primary goal of providing certainty of financing to the sector. Flick forward to a slide. I'll keep going. I'll touch on, the 12-month results. So it was a pretty successful year, really, in terms of LGFA meeting its objectives. The one objective it didn't meet was the profitability, and we did signal that in the SOI that the profit would be lower than in previous years. That's really a function of two things. It's a function of councils have been borrowing for shorter average maturity dates than what they have historically, and that's got a lot to do with affordable waters. So councils didn't know if they were going to get debt repaid, so their average term of borrowing is shorter than what it's been historically. In contrast, LGFA has just continued to borrow as normally, so we're borrowing slightly longer than what we're lending to councils at about a year longer, and that comes at a slight cost because the longer you borrow, the more you pay in terms of a credit margin. The second reason is because of the sheer demand of council lending, we're happy to maintain a much bigger liquidity book. So again, we have to issue 5-7-year bonds, and we put that money in short-dated financial assets. So we're running around $2.5 billion of liquid assets. that we have, and we have that along with the $1.5 billion standby facility with the Crown. So in total, that gives us around $4 billion of liquidity, which is enough to keep financing the sector for, you know, a good year if you get disruption in financial markets. And we certainly have had periods of disruption, like for COVID, there was a period of a couple of months where globally corporates couldn't issue for a couple of months. The GFC back in 2008. So events do come up from time to time. So that's why we have these big liquid assets. I will, so keep flicking forward. That's the annual report. So I won't go into too much more because there really isn't, it really is quite a straightforward business. We're only sort of 10 people. We issue bonds on one side and we lend it out to sort of councils on the other. We do survey our councils each year and we have very close to 100% satisfaction rate. So that's really important to us that we're meeting their needs. The strategic priorities, the only one there's two, as well as providing certainty of financing, the two things are sustainability. So we've put a lot of work into growing what we're doing for councils in the sort of past year. So we're providing sustainable loans and climate action loans, and we have been speaking to Hamilton on that. So we're keen to assist councils in what they're doing in that space. So we see that really as that is the big benefit. It's helping councils rather than LGFA reducing its own emissions, because we have such, apart from a bit of travel, we really don't have any emissions. So that's really where we can add value. And the second area is around sort of waters, and our goal in that area is to assist the sector. It's hard to be definitive about exactly what that means until we know what is going to be happening. So like yourselves, we're waiting for the formation of the new government and what the policies will be, and then we'll look at the best ways we can sort of help the sector. So I'll finish there and happy to take any questions.
Thank you, Andrew. And we have the first stop, Councillor Wilson.
Chair Max, thank you for the report. My questions is in fact in the area of Three Waters, and I know we're sort of guessing at a lot of things until we get some certainty. Certainly, if you read the manifesto of the incoming government, there is the approach of creating basically a CCO for waters. I think I'm right in saying that there would have to be a legislative change that would then enable that CCO to have, to decouple its broader group accounts from council. Is that your understanding?
I don't know if, well, the National Party policy is that they will repeal the current sort of water legislation. So then you potentially go back to what you had before, unless there's new things sort of put in place. So councils have the ability to do CCOs at the moment. So the one that exists is Auckland Council have Watercare in a CCO. That's two waters. I mean, that could be the model going forward. In the past, Queenstown has had some of their core operations and CCOs, and they've unwound it.
So on that point, are you saying that in those examples, in Auckland Council's group accounts, Watercare's balance sheet isn't integrated?
It's in the group accounts, it's not in the parent accounts.
Which is, to my point, my understanding from the manifesto is that, in fact, National wants to take the debt off council's balance sheet, and so currently a legislative change would have to occur.
Potentially, yeah. Okay. So you have CCOs and CCTOs at the moment, and there's some have balance sheet separation and some do not. So at the moment, councils can provide support either through guarantees, uncalled capitals or loans to CCOs or CCTOs.
Right.
It would depend on the legislation whether there's, a requirement for balance sheet separation or not. Right. So at the moment, Auckland Council have a group financing approach. So Auckland Council borrow and then they on-lend to Watercare. But it's certainly possible in the future Watercare could issue debt in its own name.
All right. So my question of you obviously is for the CCO to approach the significant challenge of funding at least $1.5 billion from Hamilton's perspective of investment. We couldn't do that if it was included in our group accounts without breaking all of our covenants. So my two questions are, and I think you've sort of answered the first one. I thought there would have to be, you'd have to decouple that. So my second question is, would LGA, if accept that the debt covenants for a CCO with water assets could be significantly different to any covenants on a council? I'm just trying to...
Yeah. The answer is potentially yes, but there's so many different sort of permutations to all of this. We have to sort of look at, the best way to go forward once we have a little bit more certainty. At the moment, the LGFA covenants are measured at parent level, not group level. So if you had a CCO, potentially that wouldn't be captured as the covenants stand at the moment. But again, there's different models because a water CCO might be multiply owned, and then depending on your shareholding has financial implications to whether that's consolidated into your accounts or not, whether you own more than 50%, and the other hurdle is whether you own more than 20%. So there's all these different things. If you ended up owning less than 50%, you're going to get a different accounting treatment than if you owned 100%. So there's a lot of work. I know it's really important. It's important to us, and we're going to have a lot more discussions with you and the other councils in the next sort of month or two as we get a little bit more certainty.
And my last question, if I could, in terms of risk appetite and interest rates, have you developed any thinking in light of the fact that this is coming?
Yeah.
Right? And every bit of indication says the manifesto will be implemented. Have you started to address the question of the differential between what rate you would be charging a council versus what rate you would be trying to charge a CCO that's responsible for water infrastructure, and whether there would be a variance?
Yeah. I mean, we've done an awful lot of internal modelling on the numbers that were given to us if you separate out waters from council activities. We've looked at a lot of things in overseas countries to see what they do and what sort of models work there. So while ultimately we might have our own LGFA view or personal views, ultimately there's going to be potentially political decisions made that we don't have any sort of control over. And so balance sheet separation is one of the key things. Are balance sheets going to be separated or are they not? Because under CCOs they're potentially not.
And does that affect your risk appetite in terms of the differential for the interest?
Yeah. And then it goes to what is the security of lending of a WSE versus a council. So at the moment, councils have security over rates. As the legislation stands at the moment, a water charge has no security over property. It's just a debt that can be recovered, and potentially the WSE can reduce water flow. So it's different levels of risk. So we have to take, And it's not just LGFA, any lender would be asking the same questions about what is the security, what is the risk, what is the appropriate level of gearing, what is the business plan, the long-term business plan of the WEC, is it self-supporting, do we have confidence in that? So there's a lot of questions to be asked.
And and do you think you have capacity, keeping in mind the magnitude that's facing the country, and every council, in theory, would be needing to manage the same thing. Clearly, you don't have my question is, do you have the capacity to actually provide the funding to all of them all at the same time?
Yeah. So LGFA has about just over $20 billion of debt on issue now.
Right.
Over a third of its of the investors are overseas-based investors. So certainly there's the potential to grow that universe of getting more overseas investors. There's also the potential to issue in foreign currency. So we issued $1 billion in Australia earlier this year. So we could certainly do more in Australia. So the thing for LGFA is the primary objective is to help the sector. So if we lend only to councils and not to water entities, our balance sheet is likely going to shrink, in which case we don't need to do more offshore issuance. If the WSEs are going to be part of the overall universe, then we'll probably need to do more foreign currency issue. So we will do whatever strategy is required to deliver what the sector needs.
I'm sure he'll explain foreign currency issues, because some may need to understand what that is, but I don't dare ask as an additional question. Sorry, Chair.
Thank you, Councillor Ewan. Mayor Southgate.
So Ewan did ask a number of the questions that I was interested in. So the government, in all of their before election and their latter stuff, since they've been in national governments, the government, apart from the fact they've still got to do their coalition talks, I understand their bottom line is to get it off council books, the debt. That's what they've said time and again. So it's not likely, so if it's off council books, whatever it is, WSE, CCO, shared services model of some sort, if it's off the books, then you don't have that security over rates, do you? Because it sits there as a different sort of levy?
Yeah, I mean, those are the two options. It doesn't have to be off council books, because Tasmania is the model where the councils own the water entity and have done for a long period of time. And that works perfectly well. You know, it provides very similar sort of outcomes to what you see in other parts of Australia, which is owned quite often by the state sort of government. So either model can work.
Yeah, we can't really...
If you have balance sheet separation, the water entities potentially have to finance themselves in their own name, or the current legislation provided for an equivalent financing vehicle to LGFA, so a second financing vehicle to focus solely on financing the water entities. So that was one thing that was being talked about before the election. The legislation doesn't make that certain, it just provides that option for that to occur.
Yeah, I think it'll be interesting, won't it, though, because post the election, not all councils are going to have the same view of how to tackle this. There'll be some people wanting region, some want to stay their own. The nearest model that we've got, and some that will be prepared to partner or join up with neighbours or some other arrangement, Watercare as the closest to, an entity that charges for its own debt and investment. What risks are there in that kind of model?
Sorry, what's the...
Watercare.
Yeah, Watercare, yep.
So they're quite stable and they're levying water, but you're saying that they don't have any security over if people don't pay their water rates?
Yeah, in Auckland you get a bill just like a power bill each month, so it's separate from rates, and the security actually is...
Just like
even though people might think it's owned by Auckland Council and therefore it is a former rate, it's actually legally, it's not.
So if people don't pay their water bills, they go after them as they do any bad debtor, send a debt collection agency there and whatever, go through the courts or whatever the process is?
That's right. So the government had the option of, what security it wanted to exist. So it could have made it that it's secured over property as well, but it chose not to.
It did choose not to, even
Yeah.
though, okay,
So,
that's interesting.
So it would just be very like what you'd see with an electricity
Yeah,
sort of
but
bill.
that was an active
Yeah.
choice.
Yeah.
Just in terms of the bigger macro picture, because you and asked great questions there. Local government funding agency, you're going to have, 67 odd plus councils in a situation of unaffordability around water assets coming to you any day soon. But in respect of that, what does success look like to those who might be supported by LGFA? Because we're all going to come, apropos of the Infrastructure Commission's report on the $300 billion worth of investment required over the next 30 years, right?
Yeah.
That's incredible. Nobody has that. Ratepayers don't even have that at the moment. So what sets us up for success if this is the way we chose to look at our water entity?
Yeah, and the Infrastructure Commission's report was a very good one, and it broadly says for public infrastructure we need to double the percentage of GDP we're spending on infrastructure at the moment. So roughly from 5% of GDP to around 10%. So there's a significant increase in investment occurred. So that shouldn't come as a surprise to anyone when you look at, the roads and rail and water, etc. But as Standard & Poor's sort of say, affordability is something that is a real issue, and people are going to pay one way or the other. It doesn't, whether it's all collected through council rates or whether you break that down into council rates and a separate water charge, whether the government give more grant funding, it's still coming out of taxes one way or the other. So, my personal view is at the big picture level, there's going to have to be hard choices made about what it is we do. And that's why I personally like the idea of the Infrastructure Commission setting some of the big picture about what it is we need to sort of focus on. And hopefully, if we get WSEs being created, we do have this longer term approach towards setting good long-term plans, coordinating across regions how we sort of do things. So some potential efficiencies to be gained through all of this. That said, councils have got a whole lot better than they were 10, 20 years ago about when they're looking at their long-term plans, their infrastructure strategies. I think, the sector actually has made huge progress in setting long-term plans that are, quite realistic in what it is they want to do. Planning for growth, massive improvement on what's going on. So there's progress being made anyway. It's just, there's a lot to do and there's hard choices to be made.
There are. Last question on that though. What difference does it make with your council who's got reasonable debt? Doesn't matter that you may have underinvested for years, but you've got reasonable debt headroom. And a council like that, ours, that is so fast growing that we're up against our debt to revenue limits.
Yeah.
What difference does it make in terms of our viability with the LGFA?
I acknowledge there's an issue for growth councils in terms of the covenants are quite restrictive, that other councils don't potentially run into that issue. If you don't have to finance growth to the same extent, the existing headrooms seem to be working sort of pretty well. And of course, there's a whole lot of councils that are small in size and therefore they have internal liability policies that are even more restrictive than the LGFA covenants because they just don't feel borrowing 280% debt to revenue is prudent for a low growth community. So I think councils are all quite different, but yeah, there is an issue around high growth councils and the covenants that are required to deliver growth. Because the answer before was just not to finance that growth, and that's sort of what happened for a period of time. And now you're sort of thinking more 30 years in a lot of those growth strategies, which is really good, but financing that, you know, comes at a upfront cost.
Yep. Thank you.
Thank you.
So yeah, we're certainly happy to have more discussions with the high growth councils on that issue to see what the best solution is.
It's a while since you've been to the metro sector, isn't it?
Yeah, I think, well, the thing is the first thing is we need to see what's happening with waters, because if there's balance sheet separation, then councils might get a whole lot of debt repaid and the amount that they potentially need to borrow might be reduced if they don't have all those water commitments. So I think the first thing we need to do is sort of work out that issue and then we can look at what's left and what's required.
Okay, thank you.
Thank you for that reminder, Andrew. Yes, there is a lot more to happen before.
I thought there'd be more questions on those sort of issues in the annual report. So.
Yeah, indeed. And Councillor Bidder.
Thank you, Chair Max. Believe it or not, I am a councillor.
It's great. There's lots of that.
Yeah.
It's good to see so much diversity around the table. It's so fantastic.
The bonds you issue, who are the types of organisations that buy those bonds?
Who are the investors in those bonds?
Yeah.
Yep, so it's roughly broken down into three categories. It's offshore investors that tend to be large investment funds or central banks that like the credit of the New Zealand local government sector, but they want to invest in large amounts, you know, $50, $100 million at a time. So if they had to invest in a whole lot of individual councils, they wouldn't be interested because it would just be too fragmented and they wouldn't have the liquidity if they wanted to sell. The second big investor group is New Zealand institutional investors. That's a lot of your KiwiSaver funds, New Zealand Super Fund, ACC is a big investor, some of the community trusts. So they have New Zealand fixed interest portfolios, and so they like LGFA because it's AAA rated, so high quality. And the third group is banks. So banks run quite big liquidity books for their balance sheets. So again, they invest in very high quality assets. So they're around a third of the investor base as well. LGFA bonds are listed on the New Zealand Stock Exchange, but we get very little retail investor demand.
Yeah.
And that's largely because we're AAA rated, the yields on LGFA are below what investors can get on term deposits or buying bank securities.
Yeah.
So often retail investors chase yield a bit more, whereas institutional investors looking to create more high quality diversified portfolios. And they also value liquidity more, which is, one of the benefits. So it's those three groups. And as I mentioned before, we can issue an offshore currency. So Auckland Council can as well, but other councils are not allowed under the Local Government Act to issue in foreign currency in their own name. So that is one benefit, that as we get big, we essentially outgrow the New Zealand investor base. So if we can issue in Australian dollars, we hedge that back to New Zealand, so there's no currency risk associated with that. And then we just sort of on-lend it, so yeah.
And is there a premium above government bonds? And about what sort of level would that be?
Yep, it varies depending on maturity, but it's roughly around sort of 50 points higher.
Right.
So, you know, at a country level, the cheapest way to finance infrastructure is through New Zealand government borrowing.
Yeah.
And the second cheapest is through LGFA. Yeah. And then if you go to banks and things, LGFA has a AAA credit rating. The best bank in New Zealand is rated AA minus, so the ANZ, Westpac, ASB, BNZ, they're all AA minus. So because they are 3 credit notches below LGFA, they're paying another 50 points again on top of what LGFA is sort of paying. And then they're also trying to maximise their profit. So if you go to Hamilton, go to a bank and borrow money, they've got their own cost of borrowing, plus they're adding on margins to make profit. So it will be more expensive for you. Yeah. In contrast, LGFA is, we want to be profitable to pay our expenses, but we're not focused on maximising our profit.
Yeah.
So as we become more profitable, we will reduce our lending margins to councils because we're not trying to grow the profit. That's where we deliver the benefit.
Yeah. So with the change of government, is there any ability to lobby for sort of any adjustments to the LGFA Act for things like maybe having a government guarantee so that we're equal to government bonds, which could bring down our borrowing costs by 50 basis points?
Treasury tend to be opposed to that, regardless of who the government is, but we can sort of make the point. We do think LGFA maintaining a AAA credit rating is important.
Yes.
So, you know, potentially having more capital might be a way of taking on slightly more risk, you know, so we've got to balance those things up. But yeah, I mean, all those things are on the table to be asked. Yeah. It's not easy because you can look at Nationals Party policy, but it's potentially a government made up of 3 parties. And so we don't know what influence those other parties will also sort of have and what trade-offs will be made. We're not privy to, well, we've sort of reached out and we have discussions with like Treasury and Infrastructure Commission and Department of Internal Affairs. You know, everyone's waiting to see what decisions, well, who the government will be and what their policies will be.
Yeah. Any thoughts about, so officially the government doesn't guarantee any of this, but I suspect the reality would be that if there was big council collapses, there would be political pressure on the government to provide some sort of guarantee or backing. Is that something we could go to Treasury with and say, hey, look, you're going to get lumped with us anyway. Can we issue at sort of government bond rates? Because if we can bring our borrowing costs down a bit, it's a huge benefit to us.
Yeah, I mean, potentially what you're saying, I think, is correct, but the government tend not to want to explicitly guarantee things because otherwise the rating agencies aggregate everything they're sort of explicitly guaranteeing into the overall debt metrics. But yeah, you've seen with the Christchurch earthquakes, Kaikoura, the councils affected by the weather events, that there is sort of government support for the sector, which is important, yeah. And we've certainly seen in the UK, there's been quite a few councils that have essentially defaulted in the past sort of few years. And again, councils don't go away, they just find there's ways in which they are allowed to continue to sort of operate. So it is likely to be the same here.
Right, last
so
question.
you get, and you've seen it with Kaipara. I mean, the way every situation will potentially be different, but the solution to that sort of worked really well, and the outcomes were good in the long term through that. Different issues in Tauranga with the commissioners, but again, the outcomes, have been quite good, I think.
Yeah, last question then. Are there any councils, you don't have to name them, that you have any concerns about their ability, debt levels, etc.?
So we do, so every year councils have to report on their financial covenants as at 30th of June. So they have until 30th of November. They've hopefully adopted the annual reports by 31 October. And they provide it. And so we provide all those outcomes to our council members. So we're transparent in what those outcomes are. We also take their long-term plans and annual plans and project forward. So we're looking at forward-looking compliance. In addition, we have what we call a borrower watch list. So we look at the councils that we have the most concerns about. So we have councils like Christchurch and Auckland on there because of the materiality of their lending books. In that report, we look at those and it allows the board to focus on sort of 8 to 10 councils rather than looking at all 78.
Yeah.
And they can then ask questions, and sometimes they might tell us to go and have a meeting with the council. We tend to encourage good practice rather than tell councils what they should or shouldn't be doing.
Yeah.
So the balanced budget outcome is something we are particularly focused on. And so sometimes we will have, discussions with councils. Ultimately, LGFA has the ability not to lend if it has concerns.
Yeah. Right, thank you.
Thank you, Andrew, and Andrew. Councillor Sarah.
Chair, just a very quick question. Acknowledging all the uncertainty with Three Waters, I guess what is the process if LGFA was to consider increasing the debt to revenue covenants?
So the covenants were set by the sector in 2012 when LGFA was started. So it wasn't LGFA staff, it was actually what the sector collectively wanted in conjunction with the rating agencies. We've changed it once, which was in 2020. To do that, we need to change our multi-issuer deed, which requires all our member councils to approve it. So it is quite a high hurdle. So we do have to have I suppose something that we think that the sector will by and large agree with. We do have the Shareholders' Council, which play a really important role. So if we can get them on side and universal agreement there, then I think that's a key element in getting the support of the other councils for any sort of changes. So it is a process. Getting every council to sign off will take potentially up to 3 months to do. So it is, if we make a change, we sort of want to do it once, and we want to probably see what's happening with Waters, and then potentially look at, are there any changes to the covenants that are required for the sector?
Okay, and my final question was just in terms of Waters, say if we were looking at CCOs, but is there an opportunity to look at, say, a different debt to revenue ratio, even if it's on our balance sheet, but for Waters infrastructure, if you can clearly separate out your expenditure?
We've thought about that, so that's something that is up for discussion. I mean, you can look at what the previous modelling was about the debt to revenue levels required for the WSEs, and it's higher than what councils traditionally have been. So potentially that is something that might be required to make those models work, but we just have to have a look at the overall level of risk.
Yeah. Okay. Thank you, Andrew.
Thank you, colleagues. No questions from Jeff online? Nothing, Kesh? No. Okay, thank you. Thanks, Andrew, for your report and for answering all those questions. A little broader than we might have wanted to go, but I think certainly a product of its time. If we can ask you to take a seat in the gallery. Do I have a mover for the motion on page, what is it? 63 of the report, which is just asking us to receive the report. Councillor Sarah, seconded by Councillor Bidder. Is there any debate, councillors?
No, just thank you, Andrew, for coming in and looking forward once we've got some more clarity around waters, having potentially some further discussions around those covenants and how we enable growth within the city, which right now is, very constrained and a serious topic we need to be looking at harder. So,
Thank you. Councillor Wilson.
Very quickly, I just wanted to agree with Councillor Sarah, but I also wanted to reconfirm those growth demands with some most recent data that shows Hamilton is growing a lot faster than even we had predicted. And I guess I'm calling out to Dave Mack, who had for year upon year challenged staff's growth projections, that they were out of sync. And the most recent proof of the pudding is we are growing rapidly, which is why we have to address the problems that we're aware of. Three Waters are at the heart of it, and a funding process will be at the heart of that solution.
Thank you. Anyone else? Comments? Mayor Paula.
Thank you. Thank you for the update. I'm not sure, you must be aware I'm Deputy Chair of the Metro Sector, so I'll be having a chat with Chair Grant Smith, who does the agenda setting with me, and I think it's timely that you come to talk with the big metros on that high growth pressure, which is completely different than what the pressure in other parts of the country, as we've always said. It's a difference between paying to get your water assets compliant, which is one thing, that is facing many parts of the country. But the other thing is providing for the growth, which Ewan just commented on, the unprecedented growth to get water into houses, to get businesses, to deal with ageing infrastructure. I think we're at a critical juncture here. Like you, I'm a little bit apprehensive, but also really keen to see how the government does deal with it, because all of the political rhetoric and promises on in any party you care to name before the election around funding our future is one thing. Now, when the real numbers are on the table, it's a different thing. And LGFA, you won't be able to fund everything for everyone. So you're going to make some really strategic decisions, which is why I asked you about alignment, so that we make sure that we go after the best deals for Hamilton. And that's some work that we really need to do. Because whether we retain waters or we put them to the side, the cost to the general public to get water services is the same or more than what it is it's more than what it is today, regardless. People are going to pay more. This council can't find more revenue. We are turning over every stone at the moment, thinking of every service level that we can. We're really putting sorry, one more sentence, Max, if it's okay. Putting the staff under the pump to find more revenue. There isn't any. So borrowing, lending money from people, working in alignment is the only way forward. But we all have to get the best deal in a context where, I tell you what, you'll have every mayor around the country knocking on the door of anybody who's got a few coins to try and fund what's coming their way. Sounded very negative, didn't it? Let's say that is also a wonderful opportunity for fast-growing cities like ours, and we would embrace further conversation. There you go.
Thank you. Thank you. Councillor Sarah, did you want to write a reply at all?
actually, Councillor Ewan brought up a good point. I can't remember the exact number now, but it was well over 3% in terms of our recent population growth. It was more than any other, city in New Zealand. And so there might be a bit of a bounce back, post-COVID and various things, but when we're looking at our LTP, we do have to keep that in mind. There is no slowing down growth, unless we make Hamilton a really unattractive and crappy place to live. Or the government stops letting more people into the country, then, we're going to keep growing quickly. So I think we've just got to keep that in mind. But also when it comes to our borrowing as well, I think we need to be open-minded around that, because right now, waters is what is critical for housing. And if there's a graph that will be coming next week, and if you look at how much housing is needed over, the last 10 years or so, thanks to population growth, and how much has actually been consented, there is a growing gap that keeps growing. So, yeah, throwing it out there.
With that, let's put the motion. All those in favour? Against?
Motion is carried unanimously.
And I'll call an end to the meetings. Sadly, we won't have time now for our workshop, but I have asked that governance are in touch with Andrew and our GFA for perhaps a session that we might be able to set up on Zoom at a later date. So thank you, everyone, for your participation today. And we have a 35-minute break now before our council meeting at 1. Oh, kariki. Oh, aye, yep.
Elected members, if you would have all received from LGNZ a survey, just sort of asking if you can answer some of those questions in the survey. Take you about 10 minutes. I think the topics are very good. They're relevant to the Future for Local Government review. And so those of you under the age of 50, it's probably everyone in this room, you in particular are encouraged. So of the 50 participants that have participated, yeah, but there's only been 50 people from across all the councils in the country that have participated in the survey. It would be awesome if our council could have the most participation from across all the councils in the country, whānau. So if I'd like to encourage you, the date that link was sent out would have been around about the 11th of October. So.
Well, thank you for that cheerleading, and certainly go and have a look at it. So let's close our meeting with a karakia. So, tēnei te whakaari, tēnei te whakawātia, haumie, huie, tai kie. Thank you.